That's better that you can actually see it. So page 171, this is a shakeout of this low. Now, we don't know that that's a shakeout until after the fact of it comes ripping back and develops the right side. But we're not looking, this stock would never even come up on my radar over here. As Dave said before, we're screening, we're looking at the right side. So let's just say, we're seeing this somewhere in this area right here, and we see it's tightened up, it's forming a big base. We now can see, there was a nice shakeout here in the low, and it came ripping back. We had some institutional support here, and now it's tightening up. This is all done in hindsight because we haven't bought yet. So hindsight is fine. It's fine to use hindsight before you buy. That's the whole idea. We're able to analyze this whole left side of the base before we buy on the right side, and the right side is under development. So again, I think I answered it, but Dave, how do we know a shakeout's a shakeout and not a full-blown base failure? At this point, it is a base failure, right? I mean, we came below the base, it failed, but it came ripping right back. So in hindsight, it's a shakeout.
Yeah, it's just, I don't know. The question is, what's the stock done? And it's only by looking throughout the whole chart that's a shakeout. You probably wouldn't be in that stock at that point because it's breaking down. But once it sets up again, it's great to go back and see those things, because I love seeing shakeouts because it gets a lot of weak holders out of the stock and helps it to set back up again. Right. So
yeah, and again,
we're looking until you really just go through and analyze the whole thing.
Right, you're analyzing the quality of the setup, and you're looking at the base, and you're looking for shakeout, strengthen it. Do you have to have a shakeout? No, you don't. It might tighten up, and never comes back to that low. We've shown you example after example where you have that, where you don't have these big shakeouts. So, but a shakeout is another element that you can see if it undercuts that low and comes ripping back. Great, that's a great sign. Maybe this is on an earnings announcement. Or guidance is raised, like we've seen in some of these names. So page 174, and this is just, we talked about waiting for a change in trend, right side development, the setting up the cheat or the load cheat. After a bear market, like in 2008, post-March 2009 bottom, when most stocks fell more than 60% from their previous high, how do you start finding new trades? You mentioned earlier you don't trade stocks which have fallen more than 50%. Well, again, you say most stocks, but that's not all stocks. and I can assure you there are stocks that did not go down that much, and stocks that set up, and then stocks that maybe went down that much, but then got into an uptrend and set up a new base. So just because a stock went down 50% doesn't mean it can't rally and double from there and be in a stage 2 uptrend, and then maybe come down 20% from there and form another base. So I wouldn't scratch them off the list just because they went down that much previously. Is the base in the base? If the cup portion or the first correction portion in a VCP is down 70%, yes, if that's part of the base, then that is definitely a faulty base. It's too deep. And again, if there's not a lot of stocks setting up, then you got to wait. It's that simple. You have to wait. I know everybody wants to be in the market every day and now and under every circumstance, but there's times where you're just going to have to wait. Let's see, 180. Page 180. And we're trying to do these in chronological order, so we just go through the book, each page. With Zillow, there's a huge volume spike before the pivot point. Is this abnormal due to something unrelated? So I see right here, talking about this big volume spike right here. So again, one volume spike, sometimes you have rebalancing, like a Russell 2000 rebalancing the rebalancing index, and a stock is added to it or something like that. I'm not sure what happened there. Options expiration. There's some times that you can have extraneous circumstances, if you will. So
market could also have been a secondary on the stock. When I see a spike like that, then I just go and I look up the news, and there's probably some very obvious explanation for it. And especially if it's a one-day spike and then the stock is set up perfectly, that should be no problem.
Yeah, that's not a problem for me. In that one spike, it looks like it's something, it's an aberration. But again, I would definitely want to check the news and see what's going on. But then I see the volume comes down. Look at over here on the very right side. Look at the volume. It's virtually the lowest volume in the entire move. I'd say maybe there's one or two other days that you have volume as low as you have on that one day. And I'll just so you can see it a little better right here, right? That's right before stock starts taking off. And that's where you want to see right on that right side. That's where you want to see the volume come in. And if the stock trades, you might not see as big of a vacuum for a number of days if the stock trades a lot of volume, like a big cap name, like a Microsoft. You're not going to get a whole bunch of days of really dry volume. You might be only on one day. On small cap, mid cap names, you might see a significant volume vacuum for a number of days or a week or so, or sometimes weeks. You'll see just almost no volume, and that's very constructive. Let's see. So David and Mark mentioned that there is second chance to buy as the stock emerges from the pullback to the pivot. Is this a base on base pattern? Okay, no, it's not. The second buy point is not intuitive for me in the VCP form to the prior base. Okay. So now Dave does this a lot more than I do. Dave buys pullbacks as more of a regular part of his strategy. I'm hoping the stock doesn't pull back in the first place. I want the stock just to go and to take off from my buy point. But again, here's a few examples. Let me see if I can find any examples. So here's an example here of Microsoft where I was buying it right here. And remember I told you on the larger cap names, I like to look for the cheats and the low cheats. This is a perfect example of buying a large cap name coming off the lows, the first shot off the lows and the first buyable pivot. And that's where I'm buying right here. Now you see it goes up for a few days. You run into supply on the left side. So that's natural to maybe pull it back here. Now, Dave, maybe you can talk about how you would handle something like this if you saw this and maybe didn't buy it, and but you're going to buy it to the pullback to the breakout. How would you?
Yeah, if I miss that, I'm buying here spot right underneath 110. Then I saw it starting to pull back. What I would like to see, and you did get that on that right where that X is you had the stock trade right back down to the pivot point, and then close near the high of the day. That's the key. If it pulled back and it closed on the low, I wouldn't be buying it if it was closing on the low, because that would tell me that, hey, there's something wrong here, and maybe it's going to break through that base. But the fact that it closed on the high, then that would at least get me started. And then on the next day, when it had a really nice second day, then I would be adding to that position, and I'd be all set. So if you miss it on that first breakout, then lots of times these stocks are giving us a second chance, and sometimes that's even a better place to initiate. I wouldn't, if I didn't, you don't want to miss that initial buy point, but if you do, this is your second chance in.
Yeah, the pullback is going to be a little trickier and a little harder and more of an expert buy. And I'll tell you why. You may think, well, what's the big deal? It just pulls back to the level and you buy it there. Okay, but you have to assess. And like Dave just said, he just gave you a little nuance that I think a lot of people didn't really fully understand. Talking about the close. All right, so let's just say it pulls back. Let's assume that the breakout point is, I don't know what it is here. Let's just say 108. It comes right back to 108. So you say to yourself, now intraday, that's trading at the low of the day at that particular point. That's right at the low of the day. Not the greatest thing, right? Being at the low of the day. So, but it's right at the 108. So you say to yourself, well, if I were buying at 108 on the breakout, I'm buying it exactly where I would have been buying it. Yes, but the stock is now coming down, and you don't know if it's going to continue to pull back and how much. It may come in and pull back even more and shake out that buy point by enough that it hits your stop. So what I do is if it pulls back to that point and I'm buying it at that point, I then would like to see a strong close. I'd love to see it come back and have that close. And that's what Dave's talking about. He sees that strong close. Great. You start to say, okay, maybe I made a good buy here. It's got support right at the breakout. Now, what if it closes at the low or even goes lower? Now, you've bought it right at that breakout. It comes in and you're maybe down 3 points on it, right? Maybe you're down 2 or 3, 4%, hasn't hit your stop yet, but you're down. It closes right on the low. Well, I might actually reduce my position because it didn't get a good close. I might sell the whole thing and just wait to see if it can start turning up. Or I might just stick with my stop and say, okay, I've made a decision, 7%, 8%, whatever it is, and I'm gonna stick with it. It's a judgment call at that time, but this is more of a professional, what I call a pro buy. It takes more skill and more analysis, even intraday, to determine whether the stock's acting right or not. All right, let's see. So page 184. On the cheat, since sometimes you trade a stock which forms a cheat below the 50-day, how do you identify such a stock? Such stocks won't show up in the trend template. Well, yes, they will if you use a trend template without a 50-day, or you can put in your trend template. In MarketSmith, we have a trend template wide or loose where you can put other parameters in there. So what you're looking at, and when it below the 50-day or for a low cheat, I'll allow the stock, if it's really low in the base, I'll allow it to be 8% below the 50-day. Usually what I like to see, though, is the pivot form where when it breaks through the pivot, it actually goes to the 50-day too. So you're actually getting above the 50-day and the low cheat at the same time. Again, you're getting into more of an expert buy. There's more things that you have to look at. There's a few more moving parts. I would suggest that you really try to identify the cheats and the handles first. And then from there, you'll be able to start to see in hindsight the low cheats. And I would really look for the handles and the cheats first. The low cheats are definitely going to be more difficult. And there's a few more, like I said, moving parts. That's how I handle that. Okay, so why does Mark and Dave like an inside day? Well, simply just more tightening. Just more tightening. The more tightening you get and the more the stock calms down. And of course, we like the inside day on the right side, the very right side of the base. The more it tightens and the more it goes inside of the previous price action is more indication, especially when the volume's coming in, that supply stopped coming to market. Let's see. Does low cheat entry require volume support? The low cheat, the handle, everything is exactly the same as far as you want to see volume drying up, volume expanding on the breakout. There's no difference. Excuse me, sorry. I got a tickle. There's no difference from the low cheat, the cheat, or the handle as far as the characteristics of the volume that you want to see. It's exactly the same. What time of the day do you usually buy? How would you not get sucked into a false breakout? I don't know why 188 is, let's see. Okay, so maybe you're looking at that breakout that then comes back in and squats. That happens a lot of the time. In some markets, it happens more than others. So, Dave, what is there a specific time that you buy? I mean, I buy at any time except the first 30 seconds or minute of the day. I know you like to avoid the first 10 or 15 minutes of the day. So is there any specific times that you're buying, or
no? If a stock is going through a buy point, then it doesn't matter if it's at the beginning of the day. I like to see just the first few opening trades, because sometimes you get some weird prints at the opening where the stocks gap up and then they come right back in. I like to see them settle down for the first 10 or 15 minutes. But if it's a perfect buy point, then I've got to at least get something going, at least take a small position. And then if it keeps following through, then I go ahead and add to it. So, but it could be almost any time during the day.
Okay. 191. Richard's referencing from 191 to 193. They're basically the same answer for all these charts, but saying that a couple of these examples seem to have a lot of overhead supply on the left side. Does this matter in the specific pattern? Well, really, not really. If there's not a lot of overhead supply, you're not analyzing that properly. Once again, let's just draw a line across here. So how do you come up with that's a lot of overhead supply? I mean, we're talking about 1, 2, 3, 4, 5, 6 months back. It's only traded above that level just on a few weekly occasions here and there. and the supply is quite a distance back. The majority of the price action is happening right where the pivot is developing. So I wouldn't agree with that. Another one too, as you said, 193. Again, this is a little more because now we're at the low cheat. And again, you see how you're below the 50-day, right? I was just talking about this. You can be below the 50-day, but I don't want to be more than 8%. And then when it breaks out, I'd like to see it preferably clear the 50-day too. And that's exactly what happens here. And then you reference you don't reference 194. Okay, I thought you did. 192. So again, with something like this is Apple, again, there's really no real overhead supply here. When you get to the low cheats, right? And here, this is a pause pivot, by the way, right here. Let's see if I can find that'll do it. That's a little pause pivot right there. See, it's just a few days. Now, again, over here, not much supply. And then you might be referencing here, because now you have supply on this left side. Yes, when you get to the low cheat, by definition, you're going to have some supply on the left side because it's in the lower part of the base. So that's why it's a little trickier. And again, it's a little there's less of a probability of it working. I probably should have put my phone the other way, but you shut that off.
And Mark, I would add, and we always get to this point where the questions on the low cheat and stuff. For those who are just starting out, who a lot of this is new for you, I would be careful in looking for low cheats, just because some of those you might not analyze it as well as you probably should, especially when you're starting out. And it would be better if you waited until maybe the stock was a little bit higher up in the base.
Yeah, when we first started doing this, and David joined the program years ago, we were at the Master Trader program one day live, and he came over to me on stage and he said, maybe we should drop the low cheat. This is maybe too advanced, and people are not going to get this right. And I thought about it, but I did promise to give everybody everything. So but what I think is important to understand, and what David is saying, is that like I said, I call these buys expert buys, or when I say it's an expert buy, I just simply mean there's more moving parts and there's more things to analyze. It takes a little more experience and skill to get it right. And I would agree with Dave. Try to find the cheats and the handles and the bases that are setting up as close as possible to the old highs if you're just starting, and then work your way down. I know people want to do the exact opposite. They want to buy it as low as possible, so they're going to go right to the low cheat. And just like with relative strength, a lot of people will come and say, well, you're looking at stocks in the 90s. Well, they want to find it, and they start looking at 80s because they want to find it before it becomes a 90. That's not the way to do this. It's completely backwards. And I know you got to get away from the idea of lower is better. It's not necessarily better. You're not looking for the lowest price. You're looking for the right price. The right price is when the stock moves as quickly as possible from your buy point and doesn't challenge your stop. That's the right price. All right, let's see. Page 192. Looks like there is right side compression on the second base. Why is this not the case? 192. So on the second base, why is it not the case? Let's see. On the right side, on the second base, no, there's no compression on this right side. That is very symmetrical. I mean, does this look like it's running in a V fashion? No, not at all. As a matter of fact, the left side looks much more V-shaped than the right side. This looks V-ish. This actually comes up here, and then drifts over sideways. There's right side development. So I'm not sure why you would think that. Let's see. Let's move on. 195. Let's see. So was it not a low cheat buy immediately after the break of the downtrend line? There's a volume dry up as well. So you're referring to this area right here. And yes, that is a low cheat. Absolutely. And again, so you did have a buy point. Now right here, and then you had the other buy point. Now again, you may not have seen this at this time, or you may not have the confidence to buy it at that point, and you didn't get the right side development. So in hindsight, you can see that. In real time, that might have been a little tougher buy, but this is definitely a better setup as it fully forms that right side. But absolutely, you're starting to see, and I like to hear this. I like to hear that you guys are starting to see the different floors that the elevator's stopping on. So once you have these various techniques, you'll have a bunch of chances to get on a stock before it comes, or as it's coming out of its base, before it makes that big move. And that's the whole idea of this. So kudos to you. You're getting it. Use overall market conditions when looking at tennis ball action. No, that's just looking at the stock itself. Can we place after hour pre-market orders? 197 above the, 197 above the pivot. So, I mean, this just is a question for any stock. As far as, I don't trade in the pre-markets too often. The only time I trade in pre-market is when I get a gap on a stock on maybe earnings or even aftermarket, and I want to get out of it right then and there. Maybe I get a big giant gap, and I might try to get out in pre or post market trading. Dave, do you ever trade in pre market or aftermarket?
Pre-market, it's too early. I'm probably still sleeping, but aftermarket occasionally, but it only if it's a stock that I know very well and I can see that the earnings are really good and I'm maybe adding to the position. But I would say 99% of my trading is during market hours.
Right. So page 199, can you buy a breakout after a national reaction pullback if you missed the original breakout? Netflix around 51. So I think we just covered that, and Dave said, you can buy the stock, on a pullback. Now, again, sometimes, with a natural reaction, if I miss a stock, if it's really powerful, I might actually buy it as it starts to turn up from a natural reaction, like even up here where it's extended, but it had a chance to pull back. And I call this a pullback buy, where it comes up off the lows from a natural reaction. Maybe the first, natural reaction and the second natural reaction you can buy it, but you are buying later, and there's more risk and there's less upside because, of course, it's already made a move. So that's just the caveat behind that. Page 199. Okay, we're still on 199. Why not buy first week of July? Okay, so I think this is a good example, Dave. The first week of July, let me show you where that is. And I think this is a good example of wedging. So first week of July is over here. And I would say, I'm not sure the first week, but maybe the second week, but right here is what he's referring to in July. Why not buy here as it's coming up this right side right here? And to me, that, that just does not have right side development. There's no real pause. It's just not, again, this definitely wouldn't have to look over here.
Yeah, I don't see a handle in there. The stock is coming straight up from, I don't know if that's 36, but it's straight up from that recent low at the beginning of July. And there's no handle. It's not tightening
Yeah. And then if we look at it over here now, again, get my drawing tool, like right here, I could see myself buying if it comes out right here. Now, of course, it didn't. See, again, this is why you want to wait for it to break out. If it turned up from here, I could buy it here. Now it's gone through, it's tightened up. Let me give you the VCP count here. So you got here, right? One pullback here. You got another one here. You would have another one here. And then it gets really tight right there. So I could buy it there, right? But it didn't. See, it turned around and it took out that low. So now the count sort of has to restart here. So now the count would be here, right? Pulls back from here to here, and now here to here. And then you get that last little tightening right there. See, and so sometimes a failed pattern is just part of the development of it needing a little more time to fully develop and give you that buy point. So you're living with this stock. You probably see this at some point and maybe come on your radar, and then it tightens up and you're saying, okay, well, I'm waiting for this to break out. It doesn't break out, and now it comes off, and now it comes back, starts tightening again, comes on your radar, and now really starts getting ripe. It's like waiting for the banana to get ripe. And I always say, when the banana is ripe enough, the peel like almost just falls off of it, right? A fruit, it gets ripe enough. It's so soft. You want to wait for things to ripen just right, where the trade is not only easy from a standpoint of it working, but it's easy from a standpoint of really having a clear definition and defined risk point, and to see clearly that the stock is acting normal or abnormal based on the volatility that you've seen previously. All right, let me move on here. All right, we talked about drifting up and down. Okay, so why Mark said 2 natural reactions and he plans to sell some into strength. Well, I didn't say that as a rule. I just said, generally speaking, once you have 2 to 3 natural reactions and the stock makes a move here, okay, we'll just stick with this example. You have 1, 2 natural reactions, moves up a bit more. You after you get through your second or third natural reaction and you get a decent move in the stock, usually what happens is you get a larger pullback that has to undercut a previous low. And it gets more difficult to hold because, first of all, you give up a lot more of your gain, and you start undercutting technical levels that, look scary. And so you have to kind of keep that in mind, that you're going to have more pullback as the stock gets more and more extended. You're more vulnerable. But if I get a decent profit, let's just say, I go through a natural reaction, I go through a full few natural reactions, and then I'm at a 20% profit, and my average gain is 12%. I'm almost 2 times my average gain. I took a risk of 5, 6, 7%. I'm 3 or 4 times my risk, which would be a 3 or 4 trade. Yeah, I'm probably going to start backstopping or thinking about nailing down some profits there. At least I'm part of my position.
Yeah, I think that's a good point that you made. The farther you're buying from the buy point, from the pivot point, the greater your risk gets. The farther that move gets away from, on this Netflix example, 48, the bigger risk you run in even a short-term correction pulling back 8%, and you're going to be out of the stock. So that's why it's so important to get in at the right spot and not buy an a very extended stock.
Yeah, page 201. Question is, does mid-March have a buy point? Mid-March. So I wouldn't say. I think you're talking about right here. Let me point that out. Hold on one second. So I think you're referring to right there, and I would say yes. I would say yes. I would say even down here is a little low cheat. So yeah, you do have a few buy points. Now, this low cheat here, you see, you would probably be able to go through this pullback and not get stopped out because it just came just a little bit below your purchase price. This one here, you would probably got knocked out on this decline here, and you would have to wait and then re-enter over here. But the answer is yes. That is that's definitely a pivot there. Not sure if I would have bought it, but it is a pivot point. Let's see, bullish signals, confirmations, more up days than down days. Mark's mic went dead while talking about this item, number 2. What did he say? All right, let's go to page 204. So, and Dave, if you want to talk about this, some of the things that we look at, and Dave and I are basically looking for the same things. If there's anything other than this, Dave, you can certainly elaborate. Follow through buying. Once the stock breaks out, we'd love to see multiple days of buying to show that it's not just retail buying. Retail buyers, like most of you here, are going to be, and I'm a retail buyer. I mean, even if you have a $10 or $20 million account, you're a retail buyer. You're not going to move a stock for very long, I can tell you right now. Even though you may be relatively large to most individuals, institutional buying are big institutions that need to buy hundreds of thousands of shares, millions of shares. It takes days to get that position on. So we're looking for those footprints, and those footprints show up as multiple days of buying. That would be your best sign. And even it doesn't have to happen consecutively. It might happen a breakout day, then it rests for a day, and then a few days later comes in. But there's no real, downside in between. More up days than down days. Simply counting the days. This is more for determining whether you want to hold the stock for a bigger move. So you get 5, 6 out of 7 days up. And now it starts pulling back. And instead of taking that 10 or 12% profit that you might be itching to take, it had such a good breakout that now you say, let me go through a pullback and see if I go through a natural reaction and go for a bigger move. And then within that, looking at the closes. You're having more good closes than bad closes. And how quickly is the stock coming back? If it's drifting back and trickles back and then explodes to the upside, that's exactly what you want to see. The opposite would be it trickles up and comes down real hard. It takes a lot. It's a lot quicker to erase the action versus how long it takes to move the stock up. That would be the opposite of what you want to see. So again, these are all things that you have to look at and make a determination as a whole as whether you're seeing what you need to see, and no better way than just to show you examples.
Yeah, and I would add that you want to see that institutional buying, because if you get all the people together that are listening to this call. We could move the stock, for a day, but you get 2, 3, 4, 5 institutions all buying at the same time. And these institutions are not buying $100,000 worth, a few $100,000 worth, or even $10,000 worth. They're buying millions, if not tens or hundreds of millions of dollar volume in the stock. And so it doesn't take one day for them to get positioned. It takes them sometimes weeks. And so the stocks that break out and then just go are the ones that are going to probably be the big leaders, because they're going to be buying them for 2 weeks and that stock's going to get very extended. And I don't know if it was Jesse Livermore, but Mark has experienced this, is that the stocks that you buy get enough because it takes off so fast and it just keeps on going up, are the ones that are probably going to be your biggest winners.
Yeah, some of you who may have read Stock Market Wizards, my interview with Jack Schwager, if you remember, and of course Davidson, the very first Market Wizards, he comes into my office and I was in the middle of buying some shares. I think I was buying 10,000 shares of some stock. And just as he comes in the office, I just had started buying the stock. And I said to him, I hope I don't get a good fill. And he's like, what do you mean? You don't want to get a good price? I said, no, I'd rather get a little bit of a bad price and have the stock really hard to buy and taking off, as opposed to, it's the all you can eat buffet and they give you all the stock you want and the stock doesn't go anywhere. That shows that there's supply. So when there's no supply and you've done your homework properly, as that stock starts to move, it's going to be very hard to buy. Again, these are things that you're going to have to learn and become good at and have expertise of determining. But right here is a perfect example of showing how this looks on a chart. Look, you come in here and as you're breaking out, you see each day is getting higher and higher volume, and you're coming out of here really strong, and 7 out of 9 days up. So if you buy a stock coming out of a base and you're 7 out of 9 days up and you've had a bunch of good closes and volume's real strong, you probably want to try to hold at least a portion of it, maybe sell half of it, hold a portion of it through a pullback, and then see if you can get some tennis ball action. And this pullback barely pulls back and right back into new high ground. So it's acting great. Now you go through a few of these, then you start looking to nail down a decent profit, maybe scale out of some of it and play some for a bigger move. Or you can free roll it, move your stop up and backstop it. And you've got options. Once you get into this position, you open up yourself with a lot of options, and you're not just all risk anymore. You've got profit. You can take some of that profit. You could finance your risk. We're going to talk about that later in risk management. Let's move on. Page 206. So 206, large volume down day in October. Why ignore this? Is it because it was only one bad sign? Large down day in October. I think we already talked about this, didn't we? Large down day in October. Oh, no, we did not. So this day right here, and I'll just get right there, large down day in October, right? All right, so Well, because the stock's not doing anything wrong. I mean, once you get up here, again, look at how this breaks out. 4 out of 5 days up. And now, yes, it could pull back. You're going to get some selling. Dave, I know this is something that I had to get used to over a number of years. Like when I first started trading and I bought a stock and it went up, and then the first time it pulls back, had a big down day, I get knocked out of it. And then, a few days later, the stock's a new high ground. I'm going, what the heck happened to me there? I got knocked out. And I realized it was a natural reaction. I gave back almost all my profit or a good portion of it. How do we determine here whether this is really a big problem or not? Once the stock breaks out, if you see this big volume come in on a down day.
Well, it's one day. You can't, unless the stock has a huge reversal. That had a big reversal, but look where it came. It broke out at 16, or let's say 17, went to 22. That's like a 30% move, and you have one day. Now, if you got multiple days in a row, and your profit is getting smaller and smaller, yes, then I would get worried. But that had one big day of volume, and then it quickly reversed and started back its uptrend. I've actually have found, and you'll see this on some of the strongest stocks, is that they really do not have more than 1 or 2 day reactions as it's going through its uptrend. So one day you just can't blow everything out after one day, because then you'll miss a move that took you all the way to 26. So
yeah, and there is no free lunch. Like if you want to play for a bigger move, you're going to have to hold through pullbacks. Right. Otherwise, right, Dave? you're going to have to hold through some pullbacks. Stocks do pull back.
Yeah,
but yeah. I think the question is the big volume. Is the big volume, that volume swell in that one day, is that reason to punt? No, it's not. And if you are, if that's going to spook you, then maybe you should be selling into strength and not even giving yourself a chance to go through that. But no, it's not. And at this point, in this particular situation, if this came all the way back down to the breakout and this day was huge and engulfed the entire move, then that would be something that would be suspicious. So again, you have to look at the situation and gauge it. Gauge it as you're seeing the weight of evidence developing. MVP criteria are for longer campaign holding stocks for bigger moves, or all right. So let's get to that first. 211. I'm not buying a stock purely because it meets this criteria, and I don't think Dave is either. However, if you own a stock, let's say you buy a stock and then it meets this criteria, that's a stock that you probably should not sell all of. I think you would agree with that, Dave. And also, if you don't own the stock and the stock meets this criteria, it's a stock that you probably should be looking at to buy if it forms a base subsequent to that. Is that essentially, it's your indicator, Dave. So would that be the way you would apply it?
Oh yeah, if you get that, you get that many days in a row, and then you get a proper base. This is where you can make the very very big money in the market, and that's what O'Neill would do. Is that he would just keep on adding money to his big winner, and just looking for additional buy points. But this, when you get this, 12 out of 15 days in a row, and the stock up 20% and large volume during that run, that's just telling you institutions are getting their initial positions, and this probably has a lot farther to go.
Right. And I should point out, when Dave says, someone like O'Neill was buying and adding to the position and keeps, pyramiding the buys, this isn't to say that he's chasing it up and buying it extended or late stage basis. We're talking about when it comes out of that first base, and then maybe it forms a second base. As that trend progresses and more bases and the stock gets more and more extended, then you're flipping over and you're selling. We're going to talk about this in selling, on how some of these same exact characteristics, counting days, having so many days up in a row, the really neat thing about the sell rules is they basically are the buy rules, just in a different part of the maturation cycle. So you're looking for the same thing, just it's where you apply it. So that's yet to come, and that's a very complex section. So we're not going to talk about that now. But again, yeah, you're so. But Dave, what I was saying was, if you didn't own a stock and then you saw these characteristics, that is a very strong indication that, the next base is buyable. And if you did own it, and you saw this, and maybe you have a decent profit, you're starting a new bull market off a bear market. You probably don't want to get rid of your whole position in that stock, right?
No. I mean, maybe you can trim some if it gets very extended. But then I would be looking to buy it back when it finished a brand new base, or I'd be looking to get into it for the first time if I hadn't previously bought it, because that's telling you, that type of buying with that type of volume is telling you that it's probably going to go a lot farther.
But Dave, someone's asking, what's the definition of a good close?
A good close is usually when the stock is trading on the very close to the high, if not the high of the day. Yeah. And that's just telling you that people have been buying it all day long and just haven't gotten enough, and they want to keep on buying, but the market they've run out of time, so they're going to have to come back the next day, and that's usually that's a very good sign.
Right. So the more, just think of the midway point as the inflection point. The more you get above the middle of the range, the better it is, and the more you get below it, the worse it is. If you close on the dead low, that would be a very bad close. Let's see. Okay, can you explain low volume out, high volume in? Okay, in more depth. Sure. So that's another one of the bearish signals, right? Low volume out, high volume in. Here's a perfect example where the stock comes out on. Now, it could be relatively low volume. It might be a high volume breakout. Maybe the volume is fairly good on the breakout, relative to the base, but then the stock comes back in on higher volume. That would be not the greatest scenario. Now, an even worse scenario would be the breakout is on low volume and it's not even good volume to begin with, and then you have high volume coming in. That's the worst scenario. So again, this is a perfect example of what that means. Simply, the stock has a failure, it comes back in as a pivot failure or a base failure, gets below those respective moving averages on a big swell in volume after a low volume breakout. That's a strike. That's one of the violations that you want to look for. And these violations are after the breakout, soon after the breakout, usually within a few days or a couple weeks after the breakout. This isn't later on as the stock's up, and those are a whole different set of rules that we're going to talk about later. So I guess this next question is exactly what I just said. How more bad closes than good closes, up days, down days, how long after the breakout is this applicable? Generally for the first, through the first natural reaction or couple natural reactions, the first few days to a couple weeks after the breakout. Then, like I said, as it moves on from there, then we're looking at specific sell rules. 218, how many T's? How many T's is that? Okay, so let's take a look. So that would be, let me get my drawing tool. So you'd have one right here, probably two right here, and then three. That would be a 3T. Let's look at that for a second. Do the four lower lows need to be consecutive? When we talk about the three lower lows or 3 to 4 lower lows, are they consecutive? Yes, 3 to 4, as you can see right here, consecutive lower lows. That's what lower lows means. They're right in order. 1, 2, 3 lower lows or 4. Now remember, this is the key. No supportive action on day 3 or 4. If just because you have 3 or 4 lower lows, you don't sell the stock just because of that. If it's on volume, that makes it worse. If it has bad closes, that makes it worse, right? If there's no supportive action on maybe the 4th day or so, that makes it worse. So you have to gauge the quality of the action, and that's we're just giving you tools. This is like you're building a house. You're not going to use just a saw. You need a hammer, screwdriver. You need all types of tools. We're giving you all the tools. You have to learn how to use and apply them.
And let me add on that no supportive action on day 3 or 4 and 3 to 4 consecutive lower lows. This is just the opposite of what is happening when the stock is breaking out. You want 3 to 4 consecutive days of buying and strong buying. And this is also, as if you look at the stock and analyze the stock and go back during the move, you're looking for a change. You're looking to see if there is something different going on in the action of the individual stock. And because if for the last 3 months, every time it corrects, it only has a 2-day correction, and then it goes sideways or it starts moving higher, then that's great. But then all of a sudden you get 3 or 4 days in a row that are consecutive and that are lower lows. That's just showing you change that's occurring. And that's what you're always looking for in the market. You're an observer. You're looking for change. You're looking to see how things are acting differently than they have been in the past.
Yeah. Stocks have personalities. Some are hyper, some are calm. You can really see how the stock is acting, and if it's broken, its character. That's another thing that is purely anecdotal, and you'd have to make a judgment call on that. But question here about wedging and ledges. Now the ledge, I don't want to get too much on the ledge, but the ledge is a shorting, a situation where I look to short from a ledge. But it's certainly, if a stock breaks down and starts forming a ledge, you have to be really careful. Those are stocks that can really fail miserably. So the question was, do you get concerned when a stock starts hugging a moving average, like here on the 50-day when it wedges? Oh, no, that's not it. I'm sorry. Did we cover that? How to distinguish a ledge more accurately versus a natural pullback? Okay, so a ledge is going to happen below the 50-day, below the 20-day. There's going to be a breakdown, usually below the pivot and a lot of times below the base. So, and even sometimes below the 200-day. So you're going to really have the stock show that the pivot has failed. It's not just a natural reaction is within an uptrend above the pivot point. So this is going to be below. So it's completely in a whole different part of the base, as opposed to where you see here, it's below. All the action is below the pivot and then below the base, where a natural reaction, if I can go back to a natural reaction, see, all this is all above. All this activity is above, and everything's in an uptrend. So that's the distinguishing differences there.
Yeah, and Mark, if you go back and you go back to the example you had just before. There. What you're seeing here too is a total change in character. As the stock breaks out, it doesn't hold the breakout, and then it drops quickly. 1, 2, 3 days later, it has a large day down, and then it goes sideways. It tries for 6 or 7 days, and it can't get back to where it was, previously. And then it breaks again real quickly, and it looks like it does it on some volume, and then it can't recover. That's the change you're starting to see, is that the stock drops fast on bigger volume and can't rally. It's just the opposite of what happened during the uptrend. Now, this was a fast uptrend in Michael Kors, but that's all you're always looking for, is the change in the character of how the stock is acting.
Yeah, as this stock breaks out or attempts to break out right here, what do we want to see? Want to see multiple days of follow through, good closes, bad closes? What happens? It comes out for one day, next day reverses, and then comes all the way back down, has a decent close, but a lot of volatility. And then from there, big down day, and then can't rally. The worst thing a stock can do is break and then not rally. The best thing a stock can do is rally and not pull back much. So you're judging the character. And then, as Dave said, it tries to turn back up and then bang, fails, comes right in. You get a pivot failure. I mean, this is just showing you clear cut right here. You definitely have to be out of the stock. If you haven't sold it, this is clear cut below the 50-day now. And now you just go dead sideways again. You can't rally. And now you break down, you get below the 200-day. And that's where I put it on the short list. I put that on our short list right there. And this stock went down quite a bit from there. Anyway, let's move on. 223. Let's see. Where do we exit? If we enter on the breakout, we would have made around 6% on the first day. When it comes back to the pivot, should we exit on break even? if we let it pull back even further or test our stop loss at 1380, we would have lost 8% ultimately. So, all right. So in this particular, and again, if you had set a stop, let's just say you set a stop of 8%, would you have gotten out before that based on these violations? Yeah, maybe. I probably would have trimmed. This particular name here, I can't remember. I did trade this stock, and I can't remember exactly where I sold it, but I got stopped out of it, obviously. Again, this isn't the best action. Coming out here and then having these two reversals and then not being able to rally and then rolling over right here. This is pretty much just at this number 3 is just showing 3 lower lows. That's the last straw. I mean, that, you're out of it clear cut there if it hasn't already hit your stop. Prior to that, maybe reduce. Maybe reduce. I don't think I would have completely sold it all, and I can't remember what I did on the sell side on this, but that's how to handle that. Let's see here, 229. Let's move to 229. So you did not buy the stock, although the stock met all the criteria. I was wondering why you did not buy the stock while the stock was rising up, although you were late to the party. Okay, well, first of all, I did buy the stock. I bought it right here. I bought, and I don't know if I said that here. I guess I didn't say that, but I did buy it. I bought this stock right here, and I got stopped out either this day or this day. I can't remember. It was one of these days. I got stopped out. Now, this one, I always put this up because it was very painful for me because it reset perfect, what I call a cap pattern, this little mini cheat area, if you will, a cup of the handle. And then it breaks out again, and I did not go back in it. And that was the mistake that I made. The mistake I made was not re-entering. This had a pivot failure and then a reset, and then it came out, as you can see, really strong. So I did buy it, got stopped out, didn't re-enter it, and then the stock went on to almost double in just a couple of weeks, a few weeks. Let's see here. Page 232. The circle above the 50-day, it looks like a low cheat. It looks similar to a ledge for shorting. How to distinguish? Well, it's not a ledge. You didn't get a real breakdown. It's still trading right about at the 50-day. And again, I can see how you could think that might be a ledge, but it's definitely a creative, and I told you before, this is a very creative buy, and it's definitely suspect, a little bit suspect. If this doesn't work out right away, I'm gone. But again, the low cheat, when you trade the low cheat, you definitely are adding some risk. And in this particular instance, I see what you're talking about, but it's not a ledge. It didn't really just break down and then, walk the plank. Sometimes we say, and just went straight sideways. So still okay. 234. Okay, so this here, I think this might have been the one I was talking about before. Will the breakout on the 27th of February be considered as valid, although there is time compression from early February? There's a mini VCP formed on the 27th of February as it breaks out and takes out the previous high from December. So February 27th, I can't find that exactly on this chart, but let's see what we're talking about here. So February 27th, we're talking about over here. So Dave, again, this is one that I think, I was mentioning before that looks like, it's really wedging up on this right side. And I wouldn't have been buying it. I bought this stock. I bought the stock over here, and I actually saw this stock at this time. I got wind of this stock when it had this big gap up. It was on the company raising guidance, and then I started watching it. So I did not get sucked in to buy it over here. I don't see any reason to buy it over in this section right here. But as it moves over here and tightens up, it's literally as perfect as it can get.
Yeah, I don't like stocks. See, this is the example of a stock coming off the low and going right into new high ground. So many times they have to take a break, they have to rest or even correct a bit. And so even if the stock went sideways, I guess that's 1, 2, 3, 4, 5 days and it looks like it almost broke out. But that's just not enough. I mean, the stock has gone from 8 to 12. It's a 50% move. That's where I would say, hey, look, it probably needs more time. And then you just keep your eye on it and look how nicely that thing, how nicely it tightened up and then took off. And this is this example of real tightening. The last six, let's see, 1, 2, 3, 4, 5, the last 6 days of before the stock broke out was inside that 1 day. So that's showing you very, very tight action before it broke out.
Right. And now you're seeing some of the nuances. You know, Dave is pointing out some of these nuances that we would look for. You see this outside day right here, and then you go inside to the whole pivot and volume comes in. Very constructive. And these are, you know, again, these are little things, and we're seeing more things in there. There's a real little tiny things, but we can't get so forensic and so microscopic because you're just not at that point yet. You know, you've got to be able to identify these patterns, and you'll get to that. You'll get to that even on your own. Again, this stock goes from $8 to $12, you know, making a big move. There's a lot. Remember, we talked about supply, trapped buyers. We talked about bottom fishers are going to have profits. So you're going to need to digest some of that, and you got to go through and let the towel wring itself out. Another question on this particular this chart is asking the third-ish day of January, a low cheat buy. So right here, and I'm going to and yes, it is a low cheat buy right there. And that is a pause pivot. You see there's 1 day. It pauses for one right there. Actually, I have an arrow. Why don't I use the arrow? Wouldn't that be easier? Yeah, so right there. That's your pause pivot. So that is a cheat. I hadn't seen the stock then. I wasn't watching it. I wasn't even watching the stock here. This actually, sorry, now I want the other tool. I wasn't watching the stock here. And this here, if this broke out from there, probably would have bought that if I was watching. That's actually a very nice base being formed. And that was buyable, but it just turned around, went down, and then needed more time. So it depends on where you happen to, you know, see the stock. But yes, that is a low cheat, and I think that's a real good eye that you have there. So is mid-November an IPO buy? We got a lot of questions on this particular chart. So that would be what was the mid-November? Yeah, mid-November. So I would say the IPO buy is, you know, coming through here. Yes, mid-November. Yes. Yeah, I mean, you know, that's pretty tight. You probably could buy that there. Again, I hadn't been watching it there. It's not the greatest, VCP setup, although it did tighten up a bit here on the right side. But yeah, it was buyable there too. They're like, see, you're seeing all the spots that it's buyable. There's a lot of places where you can trade this, and you could have got a nice move from 8.5 up. And again, I want to point out that these prices are adjusted for splits. Most of them had not traded at the price that you're seeing here. Some of them you're seeing are 50 cents. I'm not buying stocks that are 50 cents. And even these stocks that are $8 or $12, most of the time, you know, we're not buying those price stocks either, but they're adjusted for splits. So this might have been trading at, you know, $50 at the time. I don't know if we answered this question. I don't think so. So it's a good time to answer it. Dave, what's the lowest price stock that you'll buy as far as, you know, how low will you go on price? Do you have a cutoff?
You know, I don't have a cutoff because, I mean, I'm not gonna be taking big positions in stocks below $5. But you know, if something's $8, $10, you know, and it sets up a nice base, and it's got some, you know, it's got the fundamentals that I look for, then I'll go ahead and buy it. But most of the better price, the real leadership is above 15, 20 and higher. And these days, there's so many stocks that are trading above 100. You know, very few companies are splitting these days. But the good quality is not trading below, you know, $10 a share.
Let me give you a few insights on that. Number one, I categorize basically the price in three categories. One is below $5, or the penny stocks are really the absolute junk pile, which I never trade in at all. Below $5 in particular. and above the $5 to $12 level, I sometimes power plays. There are some situations that I will. I just pointed one out the other day to our MPA members that was low price, but I very rarely trade them, and I'm not going to take a big position usually on them. That's really the lower quality. When you get above $12, even the power plays, I like to be $12 or higher. That's sort of my cutoff for the 99.9% of my trades, and I'd like to see them much higher. But here, let me give you this bit of information and ease your mind if you think you have to find a penny stock or a low price stock to find a big winning stock. The average price of the biggest winning stocks of the last 100 years, going all the way back to the early 1900s and even the late 1800s, the average price was in the 30s before it made a big move. Before the big move was made, the average price was in the $34 range. So that just tells you right there, that you don't have to be anywhere near those low price stocks. Now, why do we want to stay away from low price stocks? Is there a particular reason that makes sense based on history or based on a reasoning around institutional support? Yes. Here's the big problem with a very low price stock. Most institutions can't buy them for a few reasons, but one of the main reasons is that you will have stocks trading, $3, $4, $5. Usually only a low priced mutual fund can buy those. And so now you just taken away a whole bunch of the firepower that you're trying to get in front of. And so you're eliminating the exact big wave that you're trying to ride. So you want to, and these stocks have to be put on an approved list and go through a committee. A low price stock is going to have a very hard time. It's a junky stock to begin with. And just purely from the fact of going back and looking at history says that it's unnecessary and you're already putting yourself in a lower quality situation. And you want to be in high quality situations. All right, let's see. Elaborate on V-shaped bases. Are they more prone to failure? Absolutely. They're much more prone to failure. And the reason is because when they come right up that right side, they're running right into that supply. And they're running into the supply, and they're also putting the bottom fishers at a very quick profit. So you have a convergence of both of those potential sellers creating supply. I think we went over this a lot already. Let's see. So that's all the specific questions. We have some general questions. I'm going to try to go through them quickly, but we're going to wrap this up. Okay. So this is a big question from Mark. I'm going to really boil it down. Is it possible to successfully basically employ a hybrid of different strategies? I'm not going to go into the whole dissertation about the strategies, but I would strongly advise against trying to hybrid strategies. It's just unnecessary. If you think that you're going to hybrid strategies and be able to be in the market every day, all the time, and switch from day trading to swing trading, from swing trading to position or long-term investing, value to growth, it's absurd. It takes a lifetime to master one strategy. But here's the thing. It's unnecessary. If you become a master at any one of those strategies, you'll make tons of money and you'll do great. So why try to be a jack of all trades when you could be a master of something? And specialists get paid well. So be a specialist and stop worrying about that. Again, that's such a scarcity mindset of worrying about you're going to miss something. I got to know everything because in every situation I got to make sure I'm prepared. It's such a scarcity mindset, and it misses the whole point of trading. It's like a baseball player trying to hit every single pitch. No, a baseball player waits for his pitch to come in his strike zone. That's the whole idea. That's how you make a career on that. All right, let me move on. Multiple time frame analysis. Weekly might be failure, but I don't really understand this. But if the weekly is a failure, then the daily is not going to look good. So you're going to want to see all your time frames look good. Okay, a lot of these we already answered, but do we use SMAs or EMAs, exponential moving averages are simple. I use simple moving averages. I think, Dave, there's no magic moving average, right, that you use. You're just using simple moving averages.
Some on a few I'm using exponential, but that's simple moving averages are fine.
Yeah, I use simple moving averages for everything. I don't find any benefit of using one or the other. Any more benefit. Let's see. So how do you screen for low cheat stocks? I assume they will not be part of the 1 month or 5 month trend template. Of course they will be. They still have to be in an uptrend. A low cheat doesn't mean that again, remember what I said. You got to listen very carefully to what I say. Everything that we talk about in chronological order through this entire workshop builds on what we said previously. Nothing negates what we previously said. So when we say a stock has to be in a stage 2 uptrend, anything we talk about from that point on is in a stage 2 uptrend. It doesn't mean that the stock's not in a stage 2 uptrend. All those are still continuation patterns. So a cheat area is still going to be within a stage 2 uptrend. How do you handle an otherwise perfect stock setup that has all the criteria, but then opens below a pivot due to geopolitical events? So if it opens below the pivot, then I guess we don't have a chance to buy it, right? I mean, does it really matter why it happens? You're trying to come up with a reason that you could maybe bypass the rules and say, well, it's a geopolitical event, so we can not worry about that. Look, if the stock was so strong, it would hold up under that geopolitical event or whatever it is. I mean, you just gotta trade the chart. All right, we talked about that. All right, most of these we got to, so I'm just going through them. Do you suggest limit orders for filling in close to the pivot breakout level? More than often than not, I end up buying a lot higher because of lots of emotions that rush in at the live buy point. So look, you've got to be disciplined. And if you're not, then yes, maybe you should use a limit order so you don't chase it up. If you're putting in a large order, I wouldn't put 10 or 20,000 shares at the market at the stock breaking out of a very quiet pivot. No, you could run it up and get hosed on that. If you're buying 500 shares or 1,000, you can use a market order. They're not going to take advantage of you. I know we heard about hunting for stops and all that. Look, you can't account for that. There's these some people think there's this conspiracy and the market makers are going to take the stock down. Okay, yeah, maybe on a thin stock and it's really close to your price, you might get clipped out and they may take it down a little bit, but they're not moving, they're not manipulating the stock, 5-10%. So again, I went into a different topic there from hunting for stops, but again, just to set the stop, buy the stock at the right price, not too far from the breakout. If you're prone to chasing it up, use a limit order, and don't worry about people hunting for stops. Let's see. All right, I think we're going to wrap it up. That's about it. We'll wrap it up. We've been going for quite a while here. I think we've exhausted a lot of questions. We're going to do this again tomorrow night I'm not even sure. We may just do a replay of this. That's what we were originally going to do. I'm not sure if we're still going to do it live. But we're going to do another question and answer session to accommodate people in different time zones. But what we found is virtually everybody is coming in regardless of where you are, is coming in on the first sessions. We had almost no new unique people coming in on the later sessions, so it almost wasn't even necessary to have a second session, although I know many of you have commented that you love being able to see it twice. So it is a good thing after all. But as far as accommodating the different time zones, that hasn't been much of an issue. So again, but we'll announce that. I guess we're scheduled to come in at 6:00 tomorrow. So there will be something happening tomorrow at 6:00 p.m. Eastern time. So I'm going to wrap it up. Dave, thanks a lot.
Yes.
And we'll talk to you later. We'll be hearing more from Dave, of course, and then we'll be next weekend. We've got 2 days of curriculum. We still have Monday. There's a lot more to go. We're not even close to this being completed here. So get ready for a lot more information. I hope this has been helpful, and I'll talk to you guys later. Bye-bye.
All right, guys, that will conclude the replay of the question and answer session. I do see a bunch of questions that are posted here, so we will add these to the mix. I'll leave the room open for just a little while longer for anybody else. I'm glad the replay helped a lot of you. Of course it is. Anytime you're going to get the amount of knowledge you're going to be getting or you have been getting, and last weekend included, it's only going to get more involved with this coming weekend. Of course, it's a lot to absorb. That's why this year was such a benefit for you guys from a learning experience, because you get to see and listen to some of this repeatedly, whereas in the in-person event, of course, you get a one-time shot only, and that's it. And it's coming fast and furious, of course, the whole time. We will be back tomorrow night, 6 o'clock Eastern time, for the live Q&A session. I don't have any other details for you other than the fact that it will be tomorrow night shown live. So for those that are asking about replays for that, we'll share that information with you tomorrow. I'm sure Mark will make that final decision. And of course, we'll be completely right back on pace with Saturday 2 sessions, Sunday 2 sessions, concluding with the Monday live trading day. Hope you enjoyed it. We'll be in touch. Speak to you soon, and good luck trading with tomorrow.